Welcome to Credit Exchange, your weekly podcast where we speak to the biggest newsmakers and news shapers in finance. I'm your host, Lisa Lee. This week, my guest is Gauthier Reymondier, head of European credit at Bain Capital Credit. Bain Capital is a private equity powerhouse with $200 billion in AUM, and Bain Capital Credit is their credit arm. Welcome.
Thank you very much, Lisa. Great to be here with you today.
I'm so glad to have you to discuss so much of the changing dynamics and winds that's sort of hitting Europe right now.
Sure.
So let's start with the big one. Iran war. That has spiked energy prices, but it seems to be over. Can you explain a little bit how you see this war and how it's playing out, and now that there seems to be some resolution?
Sure. Well, I think the Iran situation was, to some extent in the making for years and years and years, but has taken an unexpected turn back in February with the start of the war. I think what is playing out at the moment is the base case scenario that the market is pricing in for most of the conflict. And despite the ups and downs, the closure, openings, and stuff like this, I think that is going according to plan. That's it. Will it stay the same? Will they come to a resolution? Will they sign the agreement under 60 days like it's suited? We hope so. But I think compared to the magnitude of consequences that this war and closing the Strait of Hormuz would have had in the market, what we've seen so far is the market has been extremely well behaved. And I would say the geopolitical consequences of these events has been undermining the financial markets, I would say. So it was unexpected from the market. It has consequences probably more on the inflation side of the market and so on the rates. I think from a European standpoint, I think if it stays like this, I think we'd have avoided the worst of what we paid.
I know when the war first started, there was talking about a major depression, and we've not in any way, no, I don't think anyone is expecting that. But to your point, there does seem to be inflationary pressures on the fact that we did have energy, sort of constrained energy, ships not going through the important waterway of the Strait of Hormuz. So let's talk about the macroeconomic picture. Inflation in London, here where we are, UK, and throughout Europe. So how does that make you think about the macroeconomic picture? I know the central banks are already at pause. They seem to be very soon hiking, perhaps.
I think we have two situations which are fundamentally different between the US on one side and Europe on the other side, and we can briefly discuss about the UK situation as well. I think we have, based on the macroeconomists that we have at Bain Capital, I think we are seeing the US inflation as something that is here to stay or here to be higher for longer, and which has some consequences on the rates in the US that are probably, in our view, at the moment, underpriced in the markets. I don't think that in Europe we have a very different view from the market standpoint, which is plus or minus 25 basis points. Seems like the curve of rates in Europe is fairly priced. And I think the main difference is if you think about inflation, broadly speaking, there are two engines to inflation: the activity on one side and external shocks on the other side. The European inflation above target at the moment is entirely due to the shock of Hormuz and the fact that by anticipation, some of the raw materials were already getting more expensive in the market. And we see that in the PPI prices or in leading indicators that we have seen. The growth engine of Europe has been stalling for quite a long time now. So, and before the start of the war, we were already below inflation target in Europe. And we think that if Hormuz is reopening at the moment, there are 12 ships going through every day compared to 60, 64 on average from the beginning of the year before the war. I think that inflation would go back on track by the end of the year. Early next. US has had the same inflation shock from an energy standpoint, but a little bit more moderated than Europe and Asia because of the nature of energy in the US. But it has a fantastic growth engine at the moment, which is AI, capex, and economic growth in general that unfortunately we don't have in Europe.
So tell me, what is going to be the driver of growth in Europe? Because to your point, they're not sharing in some of the AI capex spending. But yeah, I've been hearing for quite a while that Germany is going to spend more on infrastructure and on defense. Some of the consequences of the new political reality, the new world order.
Yeah, I think it's interesting because I think, Europe, I think for the best part of the post-COVID world, the post-COVID world, what we've seen in Europe growth expectations have been very mediocre. I think if you ask a macroeconomist in general, like the question of what is the growth rate in Europe is actually quite secondary in his opinion, because is it 0.5 or is it 1.5? The complexity of Europe, it's not one country, right? So when I sit and I say European growth is going to be mediocre for the next 6 months, well, it's not true in Spain.
Maybe Poland, I heard great things about.
Poland is a underrated country from a kind of how little we talk about Poland in Europe, whereas it's going to be soon the fourth largest economy on the European market. Germany has a way to solve out its growth by spending more. And then we have, geographies like France, for example, which are big economies, but have been, at zero or almost zero for a while, and we don't really see a way for them to really rebound. And so I think this kind of contrasting landscape, I think in the short term, that is really matters for financial markets. I don't think that we see a great growth opportunity in Europe. We see a rebound in some specific sub-markets or some countries in H2. I think the bigger question, which is how can Europe become a good powerhouse in the next 5 years, really needs to basically make some big changes, and that's where we're going back.
The Draghi report, which sort of laid out the growth path, problems and the path.
I think the frustrating aspect for everybody that operates in Europe, is European and not Europe, I think is that everybody knows the solution.
Yes, it's not.
It's really about implementing these solutions. And I think, on the half full glass mind, I think we've made a lot of progress. And I think the crisis that we've gone through, be it COVID, be it Ukraine, be it now Hormuz, has really sharpened the mind of the regulators on one side, of the politicians on the other side, of major economic actors that wants to basically see some consolidation. But we need some impetus, and it takes a lot more time than in a country like in the US or China. That is something that we already discussed about, where you can, for either market forces or political reasons, you can move things much faster.
Yeah, it just seems to me that more than any time in my career this year, especially with all the, as you mentioned, with Ukraine and now Hormuz, and then also the big AI, artificial intelligence revolution, in energy infrastructure is top of mind for so many people.
Yeah, it is. But I think, again, like in Europe, we have some great assets, like the grid, the interconnection, the fact that we can transport energy efficiently. I think is a good asset. It's like powering these assets and making sure that we are thinking forward with governments that are changing very often, right? We had 10 prime ministers in 10 years, 7 in Italy, 5 in Italy. It's like Italy is, by the way, the most stable.
Yeah, that's quite something, right?
So you had leveraged loans and high yield bonds and direct lending and CLOs and so much here in Europe. Do you see any play in infrastructure at all? Is there some way that you are participating in this, or is it sort of a separate investment?
So I think infra as an asset class is a very distinct assets from what we already we have made so far the conscious choice not to try to go there. The way I would say indirectly we are going to play that theme is through data centers for AI. We have a JV that we are developing in Europe, and the real estate angle of data centers is a pretty big theme, I think, for the entire market, for us as well. I think from a corporate standpoint, I think defense is a way to see how we can move to not specific funds. I don't think that's what we're trying to do, but de facto, this is one of the growth area in Europe, an area where you need some consolidation, where private capital can help the consolidation, the M&A transformation of these assets, or adding more capacity to the market. So that's what we are doing. But from an infra standpoint, I don't think that we need to go there.
Well, so the data center financing has been huge, especially they tapped private credit, they've tapped IG. In the US, they've tapped high yield bond market. They also tapped the leverage loan market, not that much, but enough that it was apparently overwhelmingly subscribed. So what is are data centers going to come here to Europe and also tap through the capital markets, and in what way? Maybe they've already done it and I just don't know.
I think that would be de facto an area, like, because if you think about the people who are financing on a private basis the European economy, they are largely the same as in the US. And so anything that has been done in the US, any technology that has been put for in the US, be it data center financing, GPU financing, everything that you need to power the AI economy, I think the same takeaway basically is the same in Europe. At the moment, the ratio between the US and Europe capex are so greatly in the US that people are already focusing on the US. But yeah, I think you're right. We will use every tool that we have in our toolbox to basically finance kind of things. I think there is obviously the danger of seeing another build or debatable return on capex that you can use. And so I think the jury is still out. And I think in Europe, usually what comes, in the market, what comes first are the easiest project, the better project type stuff. So I think you would see that coming and see probably us participate. So.
And when and let's move to defense, because you mentioned that as an area of investment that's interesting to you and supportive of like sort of the geopolitical move towards war independence for Europe. How do you play that? Because there's so many fraught things with defense, right? If you have, and I know different firms have different DEI metrics and how they think through defense. Some don't touch it at all. Others say only things are defensive, not offensive. But then you look at Ukraine, and why shouldn't Ukraine attack?
Yeah, I think I leave aside the debate of like the definition of what is acceptable or not, because it is really related to every firm.
Yeah.
And you have the overlay of who are your LPs and how your LPs align exactly with your own definition, and we are at the service of our LPs to our extent. So we never do something that we don't want to do. But if there are things that we are comfortable with that our LPs do not want us to do, then in that case, in the LP will basically take the priorities. I think the theme is really about, first of all, I think you're in Europe at the moment, it's a nascent thing. We don't see like very, very large, if you think about high yield leverage loan, there are very little big LBOs coming in this one. I think, that's a theme of like, either it's almost high grade because the big defense companies in Europe are large companies. And then you have an ecosystem of, startups or your smaller companies that are going to work either as suppliers of the big guns or trying to develop new things like drones. For example, drone is obviously a big industry that needs to grow in Europe because that's kind of a new way of defense, effective, cheaper, new technologies related. So I think that's something. And if you look at the supply chains or the value chains of all these industries, then I think maybe not exactly now, but in the next 5 to 10 years, there's a need for consolidation. There's a need for, we go back to the Draghi report, there's a need for European giants that can structure out this kind of defense, European defense, to be, more independent, not fully independent, but more independent from the US, for example, or from China.
So we've talked about different sectors and different countries. So I want to hear from you. What sectors are you most bullish on, and what countries? Because I think there is a overlap.
So I would say in the current, and I think we need to define maybe something else, which is, how much are you getting paid to take this test? Because I think I would say now we're in a situation where the bifurcation in the market is almost at an all-time high in terms of the ads and the ads nights, the ratings you want and the rating you don't want, the sectors you want and the sector you don't want. And I think it's kind of like, I think most of European managers, are trying to be defensive at the moment. And I think one of the reasons for that is uncertainties around the economy, because I think the Hormuz situation or the resolution of the Iran war has probably cut the tails, but it hasn't completely solved the uncertainty around what was the main questions before this war, which was, where do we go with the US from a trade standpoint? how can we resolve the growing imbalance of trade with China for Europe? And what kind of impact these two trends that are coming back to the geopolitical things that we were discussing initially, how does it affect the European economy? And I think if I look at the European economy, I'm still a strong believer in services. So things that are services, especially Europe for Europe, are something that we are willing to back and to continue to develop. Industrial businesses are much more difficult. And I think that is coming from, if you're relying on exports, especially, suddenly you kind of lost a little bit the US trade and the strong competition from Chinese manufacturers, not only from imports coming to Europe, but also from the development of export from China to the Asian countries that the European exporters were targeting before, I would say, 2019. I think that has made some of these businesses much more difficult. We're still reasonably strong in industrials where it's Europe for Europe, where you are local champions in a market that is going to be protected from these imports. But thinking about the imports and the dependency on supply chain for industrial businesses has become one of the most important underwriting items when we discuss an investment. I think with consumer is obviously something that we are going to be very selective about.
So how is the consumer doing? In the US, they still seem to be spending and okay. Are European consumers spending as well? Because they've got so many pressures. They have a wages that are not growing that much, but also and rising inflation. And for now, many, many years of rising inflation.
So European consumer is under pressure. I think it's kind of true across the board. It's even more true in some countries like France, where the wage growth has been very minimum in the last year, and inflation has started to go back.
And you don't have the wealth effect that you have in the US, where people think, oh, my stock portfolio went up, because they just don't seem to be as much in the market.
Albeit, if I can make a distinction here, I think you're right. The US consumer, when people are saying the US consumer is strong, they are talking about like the last 2 or 30 signs.
Yeah.
The first 6, 7 decides in the US, they are okay, and the first 2nd decide they are still pretty tense. So, but the wealth creation at the top of the pyramid in the US is so big that yes, it has sustained a lot of sectors and a lot of consumptions, and so that's what we're seeing in the numbers. And so there's a big difference between if you look at a casual dining company versus you're looking at something that is a more like high-end expense type, because some of them are much more sustained by which consumer in the US is doing great. Yeah. But broadly speaking, there's a trickling effect of this consumer in the broader economy, and the economy is still powered by the consumer, generally speaking. In Europe, we had this paradox of post-COVID, people had saved a lot of money. So if you look at consumer balance sheets versus consumer P&L, I think we have more distinction. And again, it has to be almost analyzed on country by country basis.
Yeah.
But I would say you have people that could spend in Europe, they just don't, and they keep on saving. And you have a part of the population everywhere in Europe that are suffering quite a bit because there are low-skilled people for which wages have not increased as much as the cost of living. But broadly speaking, the potential of consumer spending in Europe is much higher than what we have seen in the number. The fact is, when you hear when you've heard in 2020 that COVID was here, then in 2022 that version maybe at your door, and then that suddenly we're going to be running out of oil, about the fertilizer, and suddenly that your grocery is going to be going through the roof because it's going to cost a lot of money. And on top of that, you overlay the political situation and the big geographies where there's a lot of uncertainty. In France for the next election, UK is the perfect illustration of this kind of perfect storm that we're seeing here. I think people are very, very reluctant to spend. And I think that's if anything, Europe, about everything that we've discussed about, trust would be the bigger growth driver. It's maybe stability and growth. I think stability is important because we see in our market that without stability, people they don't spend.
Yeah.
Like, what are you going to do in the UK before you know what's the next Chancellor is going to tell us about
I was saying yes.
what are you doing in France before you know what's the result of next election. And that's why the countries that are, in Germany with the rise of, some right-wing parties and the influence that it can have, not so much at the moment at the national level, but at the regional level. But for countries that have been very stable, like Spain, for example, or Portugal with all the reforms that they've done, or Poland that we discussed a little bit, actually the trends are not that bad in consumer data.
Oh, that's really cool.
I think that's where, if we could have stability and trust,
You would have
that-
understanding on what you've done.
and we'll get your kind of 50 to 100 basis points additional growth in you.
So do you think, does that make you sort of more amenable to the consumer sector because there is that potential for people to spend? Or are you more leery because people are not spending?
I think we do credit, right? And when you do credit, it's like, I'm going back to the point that we started with, which is, are you getting paid for the risk that you're taking?
And spreads are really tight right now.
And at the moment, but the spreads in a yield, in leverage loan, direct lending, there's no point pretending otherwise, right? The numbers are the numbers, they are tight.
Yeah.
But they are tight because a lot of the companies that we are financing, they had no problem with refinancing themselves. And we see that in the market. There's plenty of demand for loans and bonds at the moment in the market.
Except maybe software and some of the disruptive sector. I think that, to your point, it's either they love it and it's all-time tights, or they hate it and it's trading at stress levels.
So I think in software, obviously software, the AI software combination is obviously something that I completely stopped the market. That I would argue for now is more a liquidity question than a credit question, especially in there's very little software in Europe. Leverage loan, I kind of 10% of software. There's much more in direct lending portfolios. But by definition, what we've done in credit for most of the managers, what we backed are cash flow, is cash flows. A very high retention, price, maintaining the prices, and high cash flow generation of these companies. As long as you see that and you don't see an inflection point, I think the credits will be okay. Now, the question is more the terminal value of these businesses, and can you refinance them in 5 years? Is the business still around? And that, obviously, if people pay you 15 to 20%, maybe you're willing to take a view. If you're paid like 6-7%, maybe you're like, it's a show me story, so maybe I'll wait for the next car to fall to see where it's going, right? And I think that's what we're seeing. Having said that, I think that green shoot in this market, we have seen system that refinance this, that basically refinance some maturities. There are some, CG that's come to the market. So for strong businesses that people have done the analysis and think that they have a moat that is good enough for the foreseeable future, I think we have that. Now the question is like, do you get paid to take consumer? Do you get paid to take? I would argue for some specific businesses, yes. But in general, people will gravitate towards the more stable, no free all-time sectors.
So let's move to direct lending or private credit that you guys also do, because that's been also massively in the headline. And perhaps, I know a lot of you guys think perhaps a little unfairly. And also a lot of the headlines is generated from the US market. A lot of the non-traded BDCs and the withdrawals that they're seeing, and then the traffic cap, that it's really for the retail wealth market and they've been capping. I know that in the Europe, we have that kind of vehicle, but the money there is so de minimis. I think it's less than double digit. It's in the single digit billions. So it's not moving the needle. A lot of them have software exposure, and that's the worry. And especially the vintages of 21 and 22, where their evaluations were very high and leverage was very high. There's worry that we might not be able to refinance them in the current structure. Now, tell me, how much do you think this also is true in Europe? And just generally, what's your thought on how like in the news kind of credit is right now?
Yeah, it's a vast question. So I think first of all, the direct lending, we've been blessed in the past few years with the press coverage and the fact that direct lending was something that people like to talk positively about. And I think people love to burn what they used to like. So I mean, not yourself, obviously, right? So I think there is an idea of like picking a headline and basically doing that. I think in the US and starting in the US, as you say, with public BDCs pricing going down and private BDCs getting that. I think the gating point is very important, right? Because if you think about people have done what they told people that they would be doing, and it's the kind of market circumstances. Having said that, when you're targeting and when some people targeted return money or quasi return money, you never know how the product has been marketed with people. We are very little, if any return money and Bain Capital, we are addressing the people that usually when they invest in our product, we talk to them. So there's no surprise about the liquidity and things like this. I think the surprises come from some people have probably thought that this was more liquid than they believe, and when they try to get out, which is compounded by the press articles and stuff like this, that's kind of become a snowball effect. And that is what it is. I think the gate is easier for that. Then we'll see whether some managers have taken too much risk or not. But I think that is starting to go a little bit like a little bit better. Where do we see a lot of defaults in this portfolio, which some is not related, right? I think it's harder for us to tell because by definition, direct lending, a lot of the financing we haven't seen this financing, right?
So how do you know if your colleagues and your peers and your rivals making things?
Visibility on my portfolio. But is your portfolio? I think on our side, there's another distinction in direct lending, which voice is very, very important. Bain Capital is, direct lending is very generic term, which has, in my view, two reality, which is the middle market direct lending and large cap direct lending. Middle market direct lending is here to finance the growth of businesses that are going to grow faster than the rest of the market because either they have superior competitive position, they get market share, or they buy competitors and they're improving their P&L. So doing that, and that's what we've been doing. We stayed like completely and consciously on middle market direct lending, both in the US and in Europe. And people can look at it in our public BDC in the US that we have. Like the results are actually quite good. And I think we are like first quartile for every single metrics on public BDCs. And I think that's the strength of obviously the team that we have in the US, but also the strategy that has been to focus on companies that can grow by themselves and they don't depend on market conditions or less on market conditions. We've done the same strategy in Europe. I think in front of our middle market direct lending, which we define as 50 to 50 million of EBITDA, broadly speaking, you have the large cap direct. I think large cap direct lending is a different beast by the quantum of money that has been invested and also by the type of investment that has been granted to companies. And I think that is probably where it's more difficult because you suddenly have extended more leverage at terms that are to some extent more difficult, especially in 2021, 2022, because let's not forget that the market has grown a lot because the leverage on the NII market was completely shut down. And to some extent for our markets, the more natural market, we kind of missed some opportunities to make some mistakes because we are not around at this point in time. Now it's changing. The most important point in direct lending, I think, is there's nothing systemic about it. Like the banks, there's no transmission to the banks. The risk is well capped. I think the recovery on the loans that are going to default, in most cases, they would be okay. But true, I think the 2021, 2022 vintages, there are some.
So there might be some funds might have poor performance. There's more of a dispersion in your estimation among some other funds rather than any real problem for the industry.
Yeah, I don't think. I think again, the direct lending has always been around, right? I joined Bain Capital in 2008, and we were doing mezzanine financings, which is direct lending. And then, we restarted with some kind of club deals and stuff like this, which is direct lending as well. So this is a market that has always existed, and it has always existed for a reason, right? There are companies that are better financed in the private markets with like higher leverage at the beginning because they had made some kind of fundamental changes to their business model, but they need a certain time to digest, and then go back to maybe, if they want, a more public market. So I'm a strong believer in direct lending as an asset class. I'm also a strong believer that direct lending is here for a reason, and that as much as you can, you should stay within these reasons and not go too much outside of these reasons, where you compete against a yield leverage loan, which also exists for a reason and have proven themselves for like 3 decades.
So one of the things that I think both direct lending, leverage on high yield would like to see more of is LBOs, is their LBO financing in many ways. I started off this podcast saying you are the credit on of a very powerful PE shop. So do you have any visibility when we're going to start seeing some LBOs, because they are not deploying or exiting much?
Yeah, so there's been like the new LBO slash M&A wave has been about to arrive. The last 3 years, every 3 months. I think we're getting there. I think there are some tangible signs that we are seeing a much better pipeline, and more importantly, a pipeline of new crates, new names, new money that should come in kind of like Q3, Q4 on the basis of what we see talking to origination people or our capital market people at Bain Capital or other private funds. That relies again on my stability and trust things, which is, for a very long time, we've seen this market picking up, and then a news comes and it stops. And the stop and go has really been the kind of motto for the past 2 to 3 years. That has prevented private equity people to sell some businesses, which the investors from these private firms want. That has also stopped the people that were willing to sell some businesses to basically press on the button, because if you sit at the board and your M&A banker cannot really guarantee you that, the 3 or 4 months that you need to basically go from start to signing, you get a window. You're like, why would I embark in that journey if it's like the last 6 months and it's like to stop? I think we've passed these points. I think there are great forces of people are not forced buyers, but they are motivated buyers, which I think is different. We have a bunch of large corporates that want to simplify their corporate structure and wants to do some divestiture and some spin-off that we're seeing. I think we see the movement in Europe of companies needs to be bigger, and so this kind of consolidation move. And we've seen that, for example, one of the good results of the year on the leverage loan and then market has been the kind of the SFR story. And SFR only is a good story because France accepted to move from 4 to 3 operators, illustrating the fact that, M&A is on the rise again and has a little bit of more, positive pressure from the regulators.
And so thank you so much. It's a great conversation. So I have my final one. We're right in the heat of, it's hot also, but also in the heat of the World Cup. Your prediction who's going to take the crown?
So I don't really do prediction. Obviously, I would love France to win.
Right.
And living in London, I would love France to win on a goal from Michael Olise, who is born and raised in the UK, but I've chosen to play for France. So that would be my dream. And if we can do that against Argentina in final, that would be the perfect.
Perfect. Okay, great. Thank you so much, Bas. As hope you come back. It's absolutely great. Delightful.
Thank you very much.
And to my audience, thank you for joining me for another edition of Credit Exchange. And do follow us on Apple and Spotify. And now we're on YouTube. So go there and watch. Thank you, and see you next week.